Hello friends, today's session is about market concentration. The topics to be covered are stochastic and deterministic theories in reference to market concentration. Friends, let's understand the introduction. Market concentration is used when smaller firms account for large percentage of the total market. It measures the extent of domination of sales by one or more firms in a particular market. The market concentration ratio is measured by the concentration ratio. The market concentration ratio measures the combined market share of all the top firms in the industry. Market share is used as a reference here in the formula. It could be sales, employment statistics, number of people using a company's services, number of outlets, etc. The value of top firms or top n firms may be 3 or maximum 5. If the top firms keep on gaining market share, then we say that the industry has become highly concentrated. Concentration in markets can be understood by modeling the dominating position of the firms. Therefore, the engineering models are being used in economics for determining the market concentration. In economics, a model is a theoretical construct representing economic process by a set of variables and a set of logical or quantitative relationships between them. The economic model is a simplified framework designed to illustrate complex processes, often but not always mathematical. Frequently, economic models posit structural parameters. Structural parameters are underlying parameters in a model or class of models. A model may have various exogenous variables, and those variables may change to create various responses by economic variables. Methodological uses of models include investigation, theorizing, and fitting theories to the world. Models in economics can be classified into two: stochastic and deterministic. Friends, let's understand about stochastic modeling. A stochastic model represents a situation where uncertainty is present. In other words, it is a model for a process that has some kind of randomness. In this model, ranges of value in the form of probability distribution are used. In other words, we can say that stochastic modeling concerns the use of probability to model real-world situations in which uncertainty is present. Stochastic modeling is a form of financial modeling that includes one or more random variables. The purpose of such modeling is to estimate how probable outcomes are within a forecast to predict conditions for different situations. The Monte Carlo simulation is one example of stochastic model when used for portfolio evaluation. Various simulations of how a portfolio may perform are developed based on probability distribution of individual stock returns. Thus, stochastic approach here focuses attention squarely on the problem of actual concentration change. Fundamental to this approach is the idea that the actual process of concentration change reflects the net effect of a multitude of uncertain influences affecting the decisions and growth rates of individual firms. Among these influences, certain things like days lost through strikes, exchange rate movements, the success of advertising campaign, or a new product launch may be listed. The important point from that stochastic point of view, however, is not what these factors are, but rather that each firm's performance in a particular period is likely to be uncertain because of the multitude of influences at work. Given this view, the appropriate thing to do is not to look into detail at these influences, but rather to make general assumptions about the process of concentration change. The approach thus argues that chance plays a crucial role in explaining concentration change, but that such change is not random but is subject to general rules. Stochastic models of various degrees of sophistication can be constructed, but for present purpose we stick to the simplest case in order to bring out general principles. Consequently, we abstract from the possibilities of entry, exit and merger and assume a given number of firms in an industry. Our central hypothesis, called the law of proportionate effect, is that each of these firms faces a given probability distribution of proportionate growth, which is independent of its size. Thus, according to this assumption, the chance that each firm will grow by p% in a certain period does not depend on its current size. A process which supports this assumption is called a Gibrat process. The first formal model on industrial dynamics was presented by Robert Gibrat in 1931, where he proposed that the firm growth is independent of the firm size. In general, processes characterized by Gibrat's law converge to a limiting distribution, which may be log normal or power law, depending on more specific assumptions about the stochastic growth process. Thus, the law is thus of equiproportionate growth in the probability sense, although of course the actual outcome growth rates for each firm will not be equal. Several points should be noted before we look at a simple example of the law in action. First, the law is one of the proportionate rather than absolute growth, and this may seem intuitively reasonable a priori. This is the factor that imparts the empirically desirable property of positive skewness to the firm size distribution. Second, the Gibrat process gives rise to a tendency for concentration to increase persistently over time by increasing the inequality aspect of market concentration in contrast to the emphasis of firm numbers. It should also be noted that this feature of the process is not dependent on proportionate rather than absolute growth effects, but rather arise if there is any dispersion in firm growth effects. Three comments can be specified here. Number 1. While more complicated models than that outline may be developed, insofar as they embody a Gibrat type of process of proportionate growth, they typically give rise to firm size distributions with positive variance and skewness similar if not identical to a log normal distribution. It is this factor more than any other which supports the use of the stochastic approach in the theory of concentration, because it is just these features which characterize many empirical firm size distributions. Typically, industries consist of a large number of small firms and small number of large firms, giving a characteristic positive skew to the distribution of firms by size. The statistical regularity with which such distributions arise represents strong a priori grounds for believing that a Gibrat type process is at work, although of course it may not represent the whole story. Number 2, it is important to note the neutrality of the process with respect to firm size. In postulating that the probabilities of proportionate growth are independent of firm size, the theory in no way derives the prediction of increasing competition by assuming large firm advantage. This contrasts with the scale economies theory, which gives larger firms the advantage of having lower unit costs. According to the present theory, however, concentration will increase stochastically even when unit costs are similar for all sizes of firms. If important scale economies exist favoring the growth of larger firms relative to small, then this offers an additional reason for expecting concentration to increase. Number 3. While additional effects may retard or speed the concentration process, the theory suggests that laissez-faire policies may not be sufficient to protect the competitiveness of the economy. It will of course be true that the tendency for concentration to increase owing to the Gibrat process can be offset if sufficient new firms enter the market and if small firms grow faster than large firms on average. Against these influences, however, we have firm debts arising from bankruptcy or merger, plus the fact that often large firms do not have significant advantages over small firms. The overwhelming predominance of mergers over the divestment of companies in particular acts as a force favoring concentration. This simultaneously leads to large increase in firm size and reducing firm numbers, and this factor has been important in previous times. Underlying the mergers phenomenon, however, differential internal growth rates of firms can also persistently increase concentration. This suggests that in the long run, at least, a commitment to maintain a competitive economy may require a policy not only to control mergers, but also to support small businesses in a positive way. Friends, let us understand the deterministic modeling, mathematical model in which outcomes are precisely determined through known relationship among states and events without any room for random variation. In such models, a given input will always produce the same output, such as in a known chemical reaction. In comparison, stochastic models use ranges of values for variables in the form of probability distributions. Deterministic modeling also typically dictates that there is only one set of specific values. It means that a deterministic model does not include elements of randomness. Every time you run the model with the same initial conditions, you will get the same results. In mathematical modeling, deterministic simulations contain no random variables and no degree of randomness and consist mostly of equations, for example, difference equations. These simulations have known inputs and they result in a unique set of outputs. Contrast stochastic probability simulation, which includes random variables. An example of a deterministic model is a calculation to determine the return on a 5-year investment with an annual interest rate of 7% compounded monthly. According to the deterministic approach, there will be a determinant equilibrium level of concentration in a market at a point in time, determined by given demand and cost conditions and the behavior of market participants, and towards which the market will be continuously adjusting. In particular, it is argued that technological factors will play a central role in determining efficient levels of plant operation and hence this equilibrium concentration level. An implication of this particular hypothesis is that high or increasing levels of market concentration can be explained by underlying mainly technological changes, an argument which has been used by some authors as a justification for such high levels of or increase in market concentration. The basic argument for this hypothesis comes from the standard microeconomic theory. The figure here depicts the conventional U-shaped long run average cost curve LAC1 for a firm in a competitive industry. Scale economies operate up to the least cost or optimal scale of production X1 and then scale diseconomies immediately set in. In long run, competitive equilibrium price will be P1 such that P1 is equal to LAC1 is equal to LMC1, which is not drawn, and there is corresponding market demand D1 which is equal to function of P1. Each firm will be of optimal size X1 and the level of concentration in the market as measured by 1 upon n, that is X1 upon D1. It follows that a rise in the ratio of optimal scale to market size owing to a technological change will reduce the number of market participants, thereby increasing market concentration. This is illustrated in the figure by a downward shift in the long run average cost to LAC2, which increases optimal scale to X2 and reduces the competitive price to P2. Concentration will increase in competitive equilibrium of the growth in market size, that is D2 upon D1, which will be less than the increase in optimal scale, that is X2 upon X1. The comments regarding this can be specified here. Number 1, the scale of economies hypothesis concerns the number of firms which can operate in a market given cost and demand conditions. It does bit specifically address aspects of the market share inequality of market concentration. Number 2, the hypothesis emphasizes the importance of scale economies relative to market size rather than scale economies per se. The existence of substantial scale economies implies large firms, but if the market is also very large, then it may not necessarily be the case that the number of market participants will be low. Finally, it should be noted that the theory is a long run equilibrium theory, and in particular that a change of the type envisaged in the shift from LAC1 to LAC2 might take many years to establish a new equilibrium. Technical developments may permit the bulk handling of chemical products, thereby enabling firms to gain economies of increased dimensions. But plant capacities cannot be increased overnight, and a long period of investment and adaptation to the new opportunity may be necessary. The theory suggests that eventually a new equilibrium with fewer firms will arise, but the prediction is a long run one. This point is of some relevance in interpreting the evidence and implications of this hypothesis. The theory is a simplification in at least two respects. First, it assumes that long run average cost curves are U-shaped when a great deal of evidence suggests that they are in fact L-shaped. The figure here introduces this modification wherein scale economies operate to scale X1, the minimum efficient scale, that is MES, and constant costs prevail thereafter. This modification suggests only that scale economies set a lower bound to concentration in competitive conditions, in that 1 upon n is greater than equal to x1 upon d1. Indeed, in this case the firms may be of unequal size, that is x1 or above, so that without some specification of the distribution of firm size, we no longer have a completely specified theory of concentration. Second, this problem is complicated if equilibrium price is greater than P1, as it may be in oligopolistic or monopolistic circumstances. If the equilibrium price is P2, say in the figure, then firms of less than minimum efficient scale may operate so that x2 upon d2 sets the minimum concentration level 1 upon n. Clearly, the distance x2 x1, which measures the extent to which production at less than MES is possible, depends upon the steepness of LAC, that is, the cost disadvantage of operation at suboptimal scale. The specified provisions weaken the scale economies theory of market concentration, in that it is necessary to introduce arbitrary hypotheses to take account of firm size inequality and suboptimal production. The simplest hypothesis is that equilibrium is such that the distribution of market shares is fixed about the ratio of minimum efficient scale to market size. This hypothesis is unlikely to be true. A central problem with the empirical studies of the scale economies hypothesis centers on the measurement of scale economies. Broadly speaking, the estimates of scale economies are obtained either in limited quantity by painstaking research or in greater numbers by more arbitrary procedures. Given these reservations, conclusions at this stage must be tentative. It does not seem unreasonable to suggest that the evidence is consistent with a technological effect in changing concentration, which is, however, only part of the story. Given that the scale economies hypothesis is a very long run one, it is observed that the broad pattern of concentration in a 10-year period or less, however, are due partly to technological changes, but predominantly to other unspecified forces. Thus, deterministic approach emphasizes on equilibrium concentration level, whereas the stochastic approach focuses on the problem of actual concentration change. Stochastic models of various degrees can be constructed. Stochastic process says that each firm's performance in a particular period is likely to be uncertain. Friends, let's summarize the session now. In this session, we learnt that modeling can help us to understand the concept of concentration of the market. In economics, a model is a theoretical construct representing economic processes by a set of variables and a set of logical or quantitative relationships between them. A model establishes an argumentative framework for applying logic and mathematics that can be independently discussed and tested, and that can be applied in various instances. We have studied two types of models. Firstly, a stochastic model. It represents a situation where uncertainty is present. In other words, it is a model for a process that has some kind of randomness. Secondly, a deterministic model. This is a mathematical model in which outcomes are precisely determined through known relationships among states and events without any room for random variation. We have examined the issue of concentration from viewpoint of both stochastic and deterministic situations. Friends, hope you understood a lot about market concentration and various models of market concentration. Thank you so much.